Look, I need you to understand something that most people won't figure out until it's too late. We're living through the final chapter of a monetary experiment that's been running since 1971, and the ending is already written. The only question is whether you'll be positioned correctly when the curtain falls. Right now, as I'm recording this, gold just hit another all-time high. Silver's up over 120% in recent months. And here's what nobody's talking about. This isn't a rally. This is the beginning of a repricing event that happens maybe once or twice in a century. The kind of move that separates those who understood what money really is from those who trusted the system. Let me show you what's actually happening behind the scenes, because the mainstream financial media is either completely missing it or deliberately ignoring it. Central banks around the world just purchased 220 tons of gold in a single quarter. That's a 28% increase from the previous quarter. Think about that for a second. The very institutions that print money, that control interest rates, that tell you inflation is transitory and everything's fine. They're dumping their own currencies and buying gold at the fastest pace in modern history. Why would they do that? What do they know that they're not telling you? Here's the thing about central banks. They don't make emotional decisions. They don't panic buy. They don't follow trends on social media. When central banks move in unison like this, it's because they've run the numbers, they've seen the projections, and they know exactly what's coming. They're preparing for a monetary reset that most people don't even know is possible. And it's not just any central banks. We're talking about China, Russia, India, Turkey, Poland, countries that represent billions of people and trillions in economic output. They're systematically reducing their dollar holdings and converting them into physical gold. This isn't a temporary shift. This is a fundamental restructuring of the global monetary system happening in real time. Let me paint you a picture of what this looks like on the ground. There's a vault in London, part of the LBMA system, where physical gold is stored for central banks and major institutions. Over the past 18 months, the outflows from these vaults have been staggering. We're talking about hundreds of tons of physical metal being withdrawn and shipped east, to China, to India, to the Middle East. It's leaving the Western banking system entirely. Now, here's where it gets interesting. At the same time this physical gold is disappearing, the paper gold market, the futures contracts traded on the COMEX, has exploded in volume. More paper claims on gold than ever before. But the physical metal backing those claims, it's vanishing. We're approaching a point where the ratio of paper gold to physical gold is becoming absurd. Some estimates put it at over 100 to 1. That means for every ounce of actual gold that exists in the system, there are 100 paper claims on it. What happens when people start asking for delivery? What happens when the music stops and everyone realizes there aren't enough chairs? That's not a hypothetical question anymore. We're watching it play out in slow motion. And here's what most people don't understand about how this system works. The price you see quoted for gold, the number that flashes across your screen, that's not determined by physical supply and demand. It's determined by paper trading in the futures market, a market where banks can create unlimited synthetic supply with the stroke of a keyboard. They've been using this mechanism to suppress the price for decades, keeping gold artificially low while they accumulate physical metal for themselves. But that game is ending. The physical market is starting to overwhelm the paper market. When central banks show up demanding delivery of actual metal, not paper promises, the whole structure starts to crack. And once it cracks, it doesn't just break, it shatters. Let me tell you about what happened in 1971, because most people under 50 have no idea how we got here. On August 15, 1971, President Nixon closed the gold window. Up until that moment, the dollar was backed by gold. Foreign governments could exchange their dollars for physical gold at a fixed rate. But the U.S. had been printing so many dollars to fund the Vietnam War and domestic spending programs that foreign governments started calling the bluff. France sent a warship to New York Harbor to pick up their gold. Germany wanted their gold back. The jig was up. So Nixon did what governments always do when they can't pay their debts. He changed the rules. He severed the link between the dollar and gold. And suddenly the dollar became a pure fiat currency, a piece of paper backed by nothing but trust in the U.S. government. And here's what happened next. In 1971, gold was $35 an ounce. By 1980, it hit $850. That's a 2,400% increase in less than a decade. People who understood what was happening, who converted their paper dollars into hard assets, they didn't just preserve their wealth. They multiplied it 20-fold while everyone else watched their purchasing power evaporate. We're at a similar inflection point right now. Actually, it's worse, because in 1971, the US was still a creditor nation. We still had manufacturing. We still had a trade surplus. Today, we're the largest debtor nation in human history. We've got over 35 trillion in official debt, and that doesn't even count the unfunded liabilities. Social Security, Medicare, government pensions. We're talking about over $200 trillion in promises that can never be kept. And how do you think they're going to handle that? The same way every government in history has handled unpayable debts. They're going to print. They're going to inflate. They're going to destroy the currency to pay off the debt in devalued dollars. Now, I know what some of you are thinking, but inflation has been coming down. The Fed says they've got it under control. Let me tell you something about official inflation numbers. They're a joke. They've changed the methodology so many times over the decades that the CPI today measures something completely different than it did in 1980. If you calculated inflation using the same methodology they used back then, real inflation right now would be in double digits. Go to the grocery store. Look at your rent. Look at your insurance premiums. Look at the cost of a new car. Does that feel like 3% inflation to you? Of course not. Because the real inflation rate, the one you experience in your daily life, is multiples higher than what they're reporting. And here's the kicker. Even with their manipulated numbers, even with all the statistical tricks they use to make inflation look lower, they still can't get it down to their 2% target. Because the inflation we're experiencing now isn't temporary, it's structural. It's baked into the system because of decades of money printing and debt accumulation. The Federal Reserve has painted themselves into a corner. If they raise interest rates high enough to actually kill inflation, they'll crash the economy and make the government's debt payments unsustainable. If they keep rates low, inflation continues to destroy purchasing power. There's no good option. They're trapped. And the bond market knows it. That's why you're seeing yields spike even as the Fed tries to signal they're done raising rates. The bond market is starting to price in the reality that the U.S. government is going to have to inflate away its debt. And when bond investors lose confidence, when they start demanding higher yields to compensate for inflation risk, that's when the death spiral begins. Here's something most people don't know. There's a concept in monetary economics called Triffin's dilemma. It describes the inherent contradiction of having a national currency serve as the world's reserve currency. To supply the world with enough dollars for international trade, the U.S. has to run persistent trade deficits, but running persistent trade deficits eventually undermines confidence in the currency. It's a trap with no escape. We've been living in this trap since 1971, and we're now reaching the endgame. Countries around the world are tired of holding dollars that lose value every year. They're tired of being subject to U.S. sanctions and having their dollar reserves frozen. They're tired of funding American deficit spending by buying treasury bonds that pay negative real yields, so they're building alternatives. The BRICS nations, Brazil, Russia, India, China, South Africa, they're working on a new currency system backed by commodities, by gold, by real assets. They represent nearly half the world's population and a growing share of global GDP. When they launch their alternative system, and they will, the demand for dollars is going to collapse. And when demand for dollars collapses, all those dollars that have been circulating overseas for decades are going to come flooding back home. That's when you'll see real inflation, the kind that destroys currencies and wipes out savings. Now let me pause here for a second because this is important. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, you need to understand that those accounts are denominated in dollars. When the dollar loses purchasing power, your retirement loses purchasing power. I put together a free guide on how gold IRAs work, how you can get physical gold into your retirement account without triggering taxes or penalties. It's in the description below. Worth looking at if you want to protect what you've spent decades building. All right, back to where this is all heading. The thing about monetary resets is they don't happen gradually. They happen suddenly. You go to bed one night and everything seems normal, and you wake up the next morning and the rules have changed. Maybe it's a bank holiday. Maybe it's capital controls. Maybe it's a currency revaluation. But by the time the average person realizes what's happening, it's too late to protect themselves. And we're seeing the warning signs everywhere. Look at what's happening in the banking system. Last year we saw multiple bank failures. Silicon Valley Bank, Signature Bank, First Republic. These weren't small community banks. These were major institutions with hundreds of billions in assets. And why did they fail? because they were holding long-term treasury bonds that collapsed in value when interest rates rose. The same treasury bonds that are supposed to be the safest assets in the world. Here's what that tells you. The banking system is far more fragile than anyone wants to admit. Banks are sitting on hundreds of billions in unrealized losses on their bond portfolios. They're only solvent on paper because they don't have to mark those bonds to market. But if depositors start getting nervous, if they start withdrawing their money, banks will be forced to sell those bonds at a loss. And that's when the contagion spreads. The FDIC, the agency that's supposed to insure your deposits, they've got about $125 billion in their insurance fund. Total bank deposits in the U.S.? Over $18 trillion. Do the math. If we get a real banking crisis, the FDIC can't possibly cover everyone. They'll have to go to the Treasury for a bailout. And where does the Treasury get the money? They print it. More inflation. More currency debasement. This is why gold and silver aren't just going up. They're being repriced to reflect the reality of our monetary system. A system built on debt, on leverage, on the assumption that growth can continue forever and debts never have to be paid back. That assumption is being tested right now, and it's failing the test. Let me tell you about silver for a minute, because silver is even more interesting than gold in some ways. Silver's up over 120% recently, and most people think it's just following gold. But silver has unique characteristics that make it potentially even more explosive. About 60% of silver demand comes from industrial uses. Solar panels, electronics, electric vehicles, medical applications. These are growing industries that need silver to function. You can't build the green energy future everyone's talking about without massive amounts of silver. But here's the problem. Silver mining is declining. Most silver comes as a byproduct of copper, lead, and zinc mining. When those base metal prices are low, silver production drops. We're heading into a situation where industrial demand for silver is exploding just as supply is contracting. That's a recipe for a price spike that could make gold's move look tame. And unlike gold, which central banks hoard, silver gets consumed. It gets used up in industrial applications, and it's gone. The above-ground stockpiles of silver have been declining for years. We're approaching a point where there might not be enough physical silver available to meet demand at any price. When that happens, when industries are competing with investors for a limited supply of physical metal, you're going to see price moves that seem impossible until they happen. There's a reason why the gold-to-silver ratio, which historically averaged around 15-1, has been as high as 120-1 in recent years. Silver has been artificially suppressed even more than gold, but that ratio is starting to compress. As silver catches up to gold, the percentage gains in silver could be multiples higher than gold. We're talking about a potential 5x, 10x, maybe more from current levels. Now, I want to talk about something that most financial advisors will never tell you, because they're not trained to think this way. They're trained to think in terms of portfolio allocation, modern portfolio theory, 60-40 stocks and bonds. But that whole framework assumes the monetary system is stable. It assumes the dollar will maintain its value. It assumes the rules won't change. What happens when those assumptions break down? What happens when the monetary system itself is in question? That's when you need to think differently. That's when you need to own assets that exist outside the financial system. Assets that don't depend on anyone's promise to pay. Assets that have been money for thousands of years. Gold and silver aren't investments in the traditional sense. They're insurance. They're a hedge against the failure of the monetary system. And right now, that insurance is still relatively cheap. But it won't stay cheap. Once the general public figures out what's happening, once the panic sets in, you won't be able to get physical metal at any reasonable price. The premiums will explode. The wait times will be months. The dealers will be sold out. We're already seeing this in certain markets. In India, in China, in the Middle East, physical gold is trading at significant premiums to the paper price. People are paying more than the spot price just to get their hands on actual metal. That premium is telling you something. It's telling you that the paper price is artificial. It's telling you that the real price, the price at which physical metal actually changes hands, is higher than what you see on your screen. And here's something that should terrify anyone paying attention. The COMEX, the exchange where gold and silver futures are traded, they've been draining their physical inventories. The amount of gold and silver available for delivery has been dropping steadily. At the same time, the open interest, the number of contracts outstanding, has been rising. More claims on less metal. This is a powder keg waiting to explode. What happens when a major player, maybe a sovereign wealth fund, maybe a billionaire who understands what's coming, what happens when they stand for delivery on a large position and the COMEX can't deliver? What happens when they default? That's when the paper market breaks. That's when price discovery moves from the futures market to the physical market. And that's when you'll see the real price of gold and silver. I want you to think about what's happening in geopolitical terms, because this isn't just about economics, this is about power. The dollar's status as the world reserve currency gives the US enormous power. It allows us to run massive deficits without consequence. It allows us to impose sanctions on other countries. It allows us to export our inflation to the rest of the world. But that power is being challenged. Russia and China have been working for years to reduce their dependence on the dollar. They're settling trade in their own currencies. They're building alternative payment systems to replace SWIFT. They're accumulating gold to back their currencies. This isn't a conspiracy theory. This is official policy that they talk about openly. And it's not just adversaries. Even allies are getting nervous. European countries have been repatriating their gold from New York. Germany brought back 300 tons. The Netherlands brought back 120 tons. Why? Because they're worried about the stability of the system. They want their gold in their own vaults, under their own control. When your allies don't trust you to hold their gold, that's a sign. That's a sign that confidence in the system is eroding. And once confidence starts to erode, it accelerates. It becomes a self-fulfilling prophecy. People lose faith in the currency, so they dump the currency, which causes it to lose value, which causes more people to lose faith. It's a vicious cycle that's very hard to stop once it starts. Here's what I think most people don't understand about wealth. Real wealth isn't numbers in a bank account. Real wealth isn't stocks or bonds or digital entries in a computer system. Real wealth is the ability to command real resources: food, energy, shelter, the things you actually need to live. And when the monetary system breaks down, when currencies lose their value, the only thing that matters is what you own that's real. Gold and silver are real. They're tangible. They're no one else's liability. You can hold them in your hand. You can store them yourself. They don't depend on a bank staying solvent or a government keeping its promises. They've been money for 5,000 years, and they'll still be money when the current system is a footnote in history books. And here's the beautiful thing about gold and silver. They're portable wealth. You can take them with you. You can hide them. You can pass them down to your children. Try doing that with a bank account that can be frozen with a keystroke. Try doing that with stocks that can be delisted or bonds that can default. Physical precious metals give you options. They give you freedom. They give you independence from a system that's increasingly unstable. Now, I know some people will say, but you can't eat gold, you can't eat silver. That's true, but you also can't eat dollars, you can't eat stocks. The difference is that gold and silver will always be accepted in exchange for the things you can eat. They're the ultimate form of liquidity. In every crisis throughout history, in every currency collapse, in every war and revolution, gold and silver have maintained their value. They've been the bridge that allowed people to preserve their wealth through the chaos. Think about what happened in Venezuela, in Zimbabwe, in Weimar Germany. In every hyperinflation, the people who survived with their wealth intact were the ones who got out of the currency and into hard assets early. The ones who waited, who trusted the government when they said everything was fine, they lost everything. Their life savings became worthless. Their pensions evaporated. Their bank accounts couldn't buy a loaf of bread. And before you think, that can't happen here, remember that every country that's experienced hyperinflation thought the same thing. They thought they were different. They thought they were special. They thought their currency was backed by the full faith and credit of the government. Until it wasn't. The US dollar has lost over 98% of its purchasing power since 1971. That's not a prediction. That's historical fact. A dollar today buys what 2 cents bought in 1971, and the pace of devaluation is accelerating. The money supply has exploded. The debt has exploded. The deficits have exploded. And there's no political will to stop it, because stopping it would require painful choices that no politician wants to make. So they'll keep printing. They'll keep spending. They'll keep kicking the can down the road until they can't anymore. And when they can't, when the bond market revolts and foreign central banks stop buying our debt and the dollar starts to collapse, that's when you'll wish you had positioned yourself correctly. Here's what I want you to understand. This isn't about timing the market. This isn't about trying to buy at the absolute bottom and sell at the absolute top. This is about recognizing a fundamental shift in the monetary system and positioning yourself accordingly. This is about insurance. This is about having a portion of your wealth in assets that will maintain their value regardless of what happens to paper currencies. The window to do this at reasonable prices is closing. Not because I say so, but because the market is telling you. Gold at all-time highs. Silver up over 120%. Central banks buying at record pace. Physical premiums expanding. Inventories draining. These are all signals that the repricing has already begun. The smart money has already moved. The question is whether you'll move before the crowd figures it out. And when the crowd figures it out, when your neighbors and coworkers and the talking heads on TV finally start talking about this, it'll be too late to get in at reasonable prices. The premiums will be 30%, 40%, 50% over spot. The wait times will be months. The dealers will be picked clean. You'll be competing with millions of other people who all woke up at the same time and realized they need to own physical metal. I've been studying monetary history for years. I've read about every currency crisis, every hyperinflation, every monetary reset. And there's a pattern. There's always a period where the warning signs are visible to anyone paying attention, where the smart money is quietly positioning itself, where you can still act without panic. That's where we are now. But that period doesn't last forever. Eventually, the crisis becomes obvious to everyone. The mainstream media starts covering it. The government starts implementing emergency measures. Capital controls get put in place. And by then, your options are limited. By then, you're reacting instead of preparing. The choice is yours. You can dismiss this as doom and gloom. You can trust that the people who created this mess will somehow fix it. You can believe that this time is different, that the laws of economics don't apply, that we can print unlimited money without consequences. Or you can look at the evidence. You can look at what central banks are doing, not what they're saying. You can look at history and recognize the patterns. You can take action while you still can. Gold and silver aren't going to make you rich overnight. That's not the point. The point is preservation. The point is having a portion of your wealth in assets that will maintain their purchasing power when paper currencies don't. The point is having options when others don't. The point is being able to sleep at night, knowing that regardless of what happens to the financial system, you've got real wealth that no one can take away from you. This is the last chance to trade fiat for hard assets at prices that will seem absurdly cheap in hindsight, not because the metals are going up, but because the currencies are going down. The repricing has already begun. The only question is whether you'll participate in it or be a victim of it. The system is locked. The path is set. The outcome is inevitable. The only variable is your position when it happens. Choose wisely.